America has thousands of banks, but most people never think about the invisible system that keeps them alive. Every day, trillions of dollars move through these institutions. A small business owner gets a loan, a family buys a house, a company expands its factory, and a person pays for coffee with a card, all connected to the same financial network. But behind those simple transactions is a complex machine made up of 4,488 banks, powerful regulations, risk calculations, and a system designed to answer one critical question. How do you keep money moving without letting the entire economy collapse? The answer reveals how one of the most powerful banking systems in the world actually works. The United States does not have one single type of bank. Instead, it has a massive ecosystem where thousands of institutions serve different purposes. At the top are the largest financial giants, banks with hundreds of billions or even trillions of dollars in assets. They operate across the country, handle global transactions, manage investments, and connect American markets with the rest of the world. But these giants are only a small part of the story. The majority of America's banks are much smaller community and regional institutions. They may not appear on global headlines, but they play a critical role in everyday life. They provide loans to local businesses, finance farms, support homeowners, and keep smaller communities economically active. This creates a unique system, a country where a global corporation can rely on a massive international bank, while a local restaurant may depend on a small bank that understands its neighborhood. But where does all the money actually come from? The answer is more surprising than many people realize. Banks do not simply store money and give it away. Their core business is transforming deposits into loans. When customers put money into a bank account, that money becomes part of the bank's financial resources. Banks then use those resources to provide loans to individuals and businesses. A mortgage allows someone to buy a home. A business loan helps a company hire workers or purchase equipment. A student loan helps someone pay for education. This process creates economic activity, but it also creates risk because every loan is a promise that money will come back in the future. If too many borrowers fail to repay, banks can face serious problems. That is why America's banking system is built around one idea: trust. To protect that trust, banks operate under strict supervision. Different government organizations monitor different parts of the system. The Federal Reserve influences interest rates and oversees major financial institutions. The Federal Deposit Insurance Corporation protects customer deposits up to a certain limit. Other regulators supervise banks depending on their structure and location. But regulation alone cannot prevent every crisis. The biggest test came in 2008, when failures in the housing market triggered a global financial meltdown. Banks had created and purchased complex financial products connected to risky mortgages. When those loans began failing, the problem spread through the financial system. Major institutions collapsed, markets crashed, and millions of people around the world felt the consequences. The crisis changed how banks were regulated and forced governments to rethink how much risk financial institutions should be allowed to take. But the next challenge was not another housing crash. It was technology. Today, America's banks are competing in a completely different environment. Digital payments, mobile banking, artificial intelligence, and financial technology companies are changing how people interact with money. A customer no longer needs to visit a physical branch to transfer money, deposit a check, or apply for a loan. But this digital transformation creates new risks. Cyber attacks have become one of the biggest threats facing modern banks. A financial system that depends on technology must constantly defend itself against criminals, hackers, and increasingly sophisticated attacks. The question is no longer only whether a bank has enough money. It is whether the entire digital infrastructure behind that money can remain secure. And the future of American banking may depend on another major shift: artificial intelligence. Banks are already using AI to detect fraud, analyze risks, automate customer service, and make faster financial decisions. But as banks become more automated, new questions emerge. How much decision-making should machines control? How can banks prevent algorithms from creating unfair outcomes? And what happens when the world's financial system becomes increasingly dependent on technology? The 4,488 banks operating across America are not just places where people keep their money. They are the foundation connecting households, businesses, governments, and global markets. Every loan approved, every payment processed, and every investment made is part of a much larger system quietly shaping the economy. The future of banking will not only be about money, it will be about trust, technology, security, and the ability to adapt. Because behind every dollar moving through the American economy is a network of institutions carrying one of the biggest responsibilities in the modern world: keeping the financial system alive